Okay, let's continue to the intrinsic value calculation of a stock using the free cash flows of the firm FCFF model of the Apple cases. Here we have attached this consolidated statement of operations 2021 and consolidated balance sheet from 10K. So we have as of 2021 and 2020 and 2021 the income statement from 10K. Here you attach it, and then here projection assumption part, those are the most important the account when we make projections on the operating cash flows, sales, cost of sales, along with this order, net sales, cost of sales, research and development, selling, general and administration, and other income and other expenses, and then the tax, right? We also have the projections in each projected year. And then I calculated all the cost of sales and R&D expense, SG&A expenses, as a percentage of the sales. The sales is the base, always the base, right? In the vertical analysis, the sales is the largest amount on the income statement. That's why we are using the sales as a percentage. And then this percentage of sales in each cost and expenses, not much changing over the years because it is what the business structure is. If they have made the cost of sales like 58%, it's not much change. They vary like around the 60 or 62 or 58 if they haven't, unless they change their business model. So we can expect other the expenses as well, as a percentage of sales. And the net operating working capital also, we can calculate the difference between the current asset and the current liability as of sales. Fixed asset, the reason why we purchase the fixed asset is to produce the probable future benefit, which is sales. That's why we put the percentage of sales. Depreciation is percentage of sales, and the tax rate and then the project year 1 to 3 and 4, 5, that need to be a research, right? We need to research to get that information. All numbers are hard number input. That means that you need to prove why this percentage. I put this on the projected assumption part. Okay, and then WACC. This I linked the WACC calculation from the previous sheet, and then this permanent growth rate I put 4%. Based on the research, you also have to put this percentage of permanent growth rate. One more thing you have to be careful about this permanent growth rates is not too high. If you put too high percentage greater than this WACC, that makes the permanent growth rate negative. So always WACC should be greater than 4% on the discounted cash flow model. And then permanent growth rate 4%. The reason why I put less than 5 or 4 or 3% is that we assume that this business model, this free cash flows, is permanent. So based on the assumption, the ongoing, the company assumption, right? So any types of industry got mature at the end of the day. So almost the same as the growth rate of a GDP of a country, that is the permanent growth rate, which is reasonable. Once we build this, the projected assumption, then we'll now create operating cash flows and then cash flows in net operating working capital to get the cash flows of changes in net operating working capital. And then cash flows and capital investment, which is fixed asset investment. And then we sum up all these operating cash flows and cash flows changes in net operating capital and cash flows of changes in fixed asset into the free cash flow of the firm. And then we got the total free cash flows of the firm, including this terminal value at the end of the year 5, using this permanent growth rate. And then we will get the enterprise value and minus the debt or preferred stock. Finally, we got the intrinsic value of common stock in total, and then we divide this common stock outstanding shares, and then we come up with the intrinsic value, which is target price of common stock per share based on DCF model. And then we'll compare the market price of common stock. Okay, so let's go from the sales. Now, where is the sales of the current year? Right, we just correlate here. Then we link this consolidated statement of operation as of 2021 end of the year, right? And then this will be increased by, right, the 10%. So 1 plus 10% that we assume. And then let's just drag it to the right. And then we got all this, the sales amount corresponding the sales growth we assumed. Again, on your research paper on Word file, you have to explain where you get, how you get this number. Where do you get this number? Okay. Cost of revenue, we assume the 60% of, right, the current sales. Once you got this equation on a cell, let's just drag. And then the gross profit is sales minus the cost of revenue. And then let's just drag. And then we got the gross profit. And that the same way, 7% of the current year sales is R&D expense. And then also the 8% of current year sales. And then we can just drag. And then the EBIT, the earning before interest and tax, is gross profit minus R&D expense minus SG&A expenses. And then let's just drag. Other income is 1% of the sales. And then let's just drag over time. Now, interest expense, I assume that interest expense is 3.6% times, right, the market value of debt. I know it is a significant amount, the amount from this interest expense we got, right? But I try to make it as conservative as possible in order to reduce the apt amount. So I assume the company will not issue the bond any longer. And then this apt is calculated EBIT plus the other income minus interest expense. Okay, and then I can just drag to the right side. And then the tax is calculated. How do we calculate? Right, we just got this tax rate along with this tax year, and then I put net income, and then I just drag. Now we got the net income amount. Finally, we have to calculate operating cash flows by adding back the interest after tax, assuming 100% equity finance, because at the end of the day, we will subtract market value of debt from enterprise value of the firm, right? So we have the two ways to get the free cash flow of the operating cash flows here the EBIT times 1 minus tax rate plus add back depreciation, or net income plus interest expense and 1 minus tax rate and add back depreciation. That results the same. So the add back interest after tax, after tax 1 minus tax rate. Then let's drag. And then add back depreciation. Then how to calculate the depreciation? Right, there you go. The depreciation is calculated by percentage of fixed asset. Then how to calculate fixed asset? Right, this 14% times sales, which is fixed asset. Now we multiply this percentage of fixed asset. Now we got add back depreciation. Add back depreciation amount should be added into the operating cash flow. So the sum of this three numbers, finally we got operating cash flows. Now let's jump into the net operating working capital. Net operating working capital we already calculated as a percentage of sales, 2.6% times the sales. Then let's drag. Okay, but what we want to calculate is not net operating working capital. We want to calculate cash flows of changes in net operating working capital, which is incremental changes every year. So if we increase net operating working capital, that means cash out because the company now use cash, right? And then we got the cash flow of changes in net operating working capital. What about fixed asset investments? In order to calculate the cash flows of changes in a fixed asset. Now, the same way here, the fixed asset, which is 11% times the sales, right? That is the fixed asset. And then let's drag. Then each percentage of percentage of sales we assumed is aligned with this. Now the sales. In the same way, what we want to calculate is incremental changes. The incremental changes in terms of cash flows. So we calculate this cash flows of changes in fixed asset. Now, finally, we just sum all those cash flows, operating cash flows of changes in net operating working capital, cash flows of changes in fixed asset up. And then finally we got this free cash flow out of firm. Now, the free cash flow out of firm are 5 years, but we assume company will be forever, right? We need to calculate terminal value after year 5, including year 6 to forever, right? So how do we calculate it? The present value, terminal value at the end of year 5, we can use the DDM model, right? This free cash flows is at the cash flows at the end of year 5 should be increased by, right, this 4% terminal value, the terminal growth rate, and then divided by weighted average cost of capital minus permanent growth rate, right? So again, you have to be careful. Don't put like 10% on it, and then you will get in trouble, huge trouble, because terminal value is minus, right? So the growth rate should be lower than the WACC, and then should be very reasonable by research. Now, once we got all the cash flows, let's just combine all the cash flows, including terminal value, at the end of year 5. Now we got all the future cash flows should be discounted. That should be discounted by WACC one more time, right? So we use MPV function from the weighted average cost of capital discount rate, and then let's just drag all these future cash flows that will be discounted by this weighted average cost of capital, 8.65%. Now, let's remove the market value of debt and preferred stock. Where do you get this number? Right here, we got this market value of debt. If the company has the market value of the preferred stock, you have to remove, because what you want to calculate is to get the intrinsic value of common stock, right? So the intrinsic value of common stock, finally, $2.8 trillion. Number of shares outstanding of the firm, we already got from WAC part. And then finally, we got the target price by the DCF model, $175. $175 per share is now intrinsic value, or the target price, if you trust this value as a stock price. That should be traded in the market. But the marketplace, the stock is now being traded at, right here, we researched it 147, right? So the expected the gain or loss based on your target price, now $28, that has potential, upside potential 19.58%, right? That is the expected rate of return if you invest in this common stock, right? The number 8 and 9 is the part of the target price based on relative method. The relative method target price, okay, I researched industry ratio 30 times. That means that, okay, in the industry, the market price of the computer software now, or computer peripherals, has 30 times multiples than, right, EPS, earning per share, right? So how do you calculate the firm's the PE ratio, right? The stock price, which is P, divided by earning per share. That means the net income divided by the number of shares. The reason why we use the net income for the upcoming year is that we want to get the target price by PE ratio forward. Always when we set up the target price is the price upcoming, right? So we use net income year 1, not the net income year, current year. And then how do you make the target price by the PE ratio? Using the industry, the ratio, right? Instead of using this from the Apple's PE ratio, we just apply the target, the industry PE ratio, right? Times, now, what do you need? Now, when you calculate this, now here, the same way, net income, where is the net income? Net income now divided by, right, which is EPS of the firm, right? We apply industry PE ratio to come up with the price of the firm. But I don't like this relative. It's just a ballpark, assuming that the company is just average in the industry. But Apple is not the average firm in the industry, right? Anyway, let's calculate it. And then we got 157, which is target price by the relative method with PE forward. We can also use this EV/EBITDA forward. EV/EBITDA forward, we can also calculate by using this industry PE, industry EV/EBITDA. EV/EBITDA means enterprise value divided by the EV plus the depreciation, right? So how do you calculate it? Again, here enterprise value, right? We have enterprise value divided by, right? The EBITDA means now we have to use EBIT and add back the depreciation, right? How much is the multiple? Because the EBIT, the EV, that means total value of the market, and then EBIT, that means the cash, actual cash generate a coming year, right? So how much multiple is applied into this ratio to measure the EV, enterprise value? So we calculate this, the firm, and then we can also use this industry ratio to measure the target price by EV/EBITDA forward. How do we calculate? In the same way, we use this industry EV/EBITDA ratio, and then times, let's go to the EBIT of a coming year, and then add this depreciation so that we get the EBITDA, right? EBITDA. So we have the EBITDA here, and then that is the enterprise value of the firm using the industry, the EBITDA, right? But what we want to get is the target price. The target price, how do we get it? Right, the minus debt, so that we can get the intrinsic value of the firm, of the common stock, and then we need to divide by number of shares outstanding. So we got $160 based on the relative method with the EBITDA. Okay, and then number 9 part is just a calculation of EVA, ROA, ROC, ROE. There are a lot of other ratios, and then you can compare industry average or the competitors, and then you can write down the differences to the research report. Okay, that's all. See you in the class. Bye bye.